welcome to The Trade. Before we get to the charts, time to have a quick look at what traders are watching. President-elect Donald Trump's pick for Treasury Secretary Scott Bessent has said that the dollar should remain the world's reserve currency, the Federal Reserve should stay independent, and that he is ready to impose tougher sanctions on Russia's oil sector. Well, China's economy likely rebounded in the fourth quarter as several rounds of policy stimulus kicked in, enabling the government to largely meet its 2024 growth target, although the risk of new US tariffs could hold back a broader recovery. We did see oil prices settling lower, with Yemen's Houthi militia expected to halt attacks on ships in the Red Sea, and investors weighing stronger than expected US retail sales data, while gold prices rose to a more than 1 month high after the latest data pressured Treasury yields further following a soft core inflation reading this week that has increased bets for a more dovish Federal Reserve policy. Let's get into the technicals. Ilya Spivak from tastylive joining me now. Great to see you as always. What is the longer term bond telling us here about what we're seeing with all this uncertainty, especially ahead of the Trump inauguration, Ilya?
Very good to be here with you, Juliet. As always, we have been so laser focused on Fed monetary policy over the past several weeks. And of course, we started the year with that. Last week, of course, a great case in point. We had a hot ISM number. We had a hot NFP jobs number out of the U.S. and the markets just took that to mean that the readjustment in yields to something higher after mid-September, when the markets looked at the dovish Fed and said, yeah, this is way too dovish, you're going to reflate the economy, then pushed out yields, pushed out the dollar. Those moves continued. Now, what we see this week, where the focus was, of course, on that U.S. CPI report and to some extent retail sales, is a bit of give back. And this is where things get interesting. The CPI number was not terribly weak, certainly, but it wasn't very much off expectations at the headline, and the core inflation rate, where the more volatile food and energy prices are taken out, that actually came in a little bit lower than expected. The markets took heart, yields came in, bonds shot higher, and we can see the very near-term down move, that series of lower highs and lower lows from early December, that's been overcome. We're right at the deciding line here at the former lows, now acting as resistance back from April, May. We can get back above over that, then we have what looks like a bona fide bottom. And what's interesting is that, of course, earlier today, the move continues. So it wasn't just a CPI move. It was something with follow through today because, of course, the retail sales report also came in a little bit light, and again encourage this idea that the Fed doesn't need to jump out the window and change its course completely. Meanwhile, the markets are at this point baking in only about half the stimulus that the Fed said it was going to deliver between this year and next in the December update. So we're still with plenty of room to go here because the markets are still way on the hawkish side of what the Fed is thinking.
Well, do you think, though, that we keep seeing a build higher on the S&P 500, or is there kind of a flashing signal that maybe there could be some trouble ahead?
Well, this is exactly why the continuation today on the bonds is so interesting, because we did not see it in the stocks. And that's really something that should be an ominous sign. Last week, obviously, there was quite a bit of weakness around the ISM number. There was a little bit of a pause while U.S. markets were closed, and then another big sell-off on the jobs number. Both of those numbers hot. Both of those numbers signaling the Fed has less room to cut and actually shifting us to just one rate cut for this year, looking at Fed funds futures. So apparently the stock market is sensitive enough to this story to sell off when the tides are turning to a more hawkish direction. But after one day's rally on CPI, even as the bonds continue to come up, even as yields continue to cool, it is not able to find fuel for another day. And we still have a series of lower highs and lower lows here. That should be an ominous sign for risk sentiment. Really, a market that can't rally on good news, even as other markets do, that should be something to be concerned about.
All right, and with all of this in mind, a lot of people saying dollar remains king, Ilya. Not great for those of us in Australia who want to go overseas. Do we get any reprieve, or does it continue to be in the greenback's favour?
Well, I think the dollar is very much a part of this story, and another place where, like with yields, you're seeing a little bit of a reprieve because, of course, that move since mid-September that ratcheted up U.S. borrowing costs also ratcheted up the dollar's yield advantage against other currencies. And we're looking at it against the Aussie here, but it's much the same chart against the euro, against the pound, against the Swiss franc, the Canadian dollar, you name it. And it was a sort of level shift in yields, in the dollar, in everything related, signaling reflation is coming. The Fed is forecasting too many cuts. Now, just as we've seen a pull-up in the bonds, so too this week we see a little bit of a pull-up in the Aussie from that low around 64.87. We're right at the deciding line here, testing that bound right around 62.75, just underneath the 63 figure. If we can get north of that, we will have overturned the down move. And again, this makes the move in equities, or the lack thereof, beyond the first day's reaction, all the more ominous because other markets seem to understand exactly what a weak retail sales number is. They seem to understand exactly what a backing off in Fed funds futures pricing to something closer to 40 basis points in cuts this year rather than 29 ahead of CPI, what that means. But stocks seem to only care about the story when it's stocks negative and to write it off beyond a single day's reaction when it should be stocks positive. And that's really a worst case scenario for stocks if they can't rally on that kind of news while other markets seem to be able to.
All right, Ilya, always great to chat. Have a great weekend. Ilya Spivak there from tastylive. That does it for this edition of The Trade. Be sure to join us again next week.